some more specifics on asset acquisitions. The next two sections, I have a separate section on asset acquisition, stock acquisitions. I have a lot of detail in here. I'm not going to cover all of these slides. I think some of the key concepts we've already sort of talked about in the overview. If I'm going through quickly, if there's anything you see on one of the slides you want to talk about, just again, interrupt me or ask questions and we'll go through it. But I want to get to some of the other slides later on when we talk about some of the special elections and the like that we can make. And I think we've used a lot of these. We talked about an applicable asset acquisition. That's basically a tax term. What that means is all of the rules that I'm talking about, I'm saying an asset acquisition, that means you're buying the assets of an entire trade or business. It could be that the company has multiple trades or business. They may not have had it segregated into a separate legal entity. I think that's probably a little bit less important. It could be in an LLC, it could be a subsidiary, it could be, but the key is it has to be a trade or business. If you're going into a company and that does whatever the company does, and you're buying 3 of their delivery trucks because you need delivery trucks in your business that has nothing to do with theirs, that's not what we're talking about. That's you're buying specific assets. That's not an asset transaction the way I'm talking about it. What I'm talking about is an applicable asset transaction. That means you're buying the assets constituting a trade or business. In the case where you're buying trucks, I feel like it's a much simpler analysis. They're selling trucks, whatever their gain is, and for you get basis in those trucks. So that's not what we're talking about here. When we're talking also about the consideration, we allocate consideration. We talked about purchase price allocation for tax, and I don't need to get into what these are, but think of it as a waterfall type concept. So when you're paying for business, you have your cash component and any liabilities you're assuming. If you're doing an asset deal, you allocate those to various classes of assets. You break up all of the assets into these 7 classes for tax purposes. For the most part, you'll notice they go from more liquid to less liquid. It's not exactly that way, but that's kind of where this goes. And what that means is you basically take your total purchase price, that includes your cash and the liabilities assumed. You allocate it to the various classes. Once you hit the full fair market value of that class, you go down to the next one until you're left ultimately with 6 and 7, which is your intangibles. Any identifiable intangibles basically go into class 6, and then you're left with kind of your goodwill and going concern value go to class 7. For tax purposes, the distinction between class 6 and 7 is not super important. Both of them have the same tax rules for a 15-year amortization. One thing I will point out also is some of us do transactions when we see like covenant not to compete. That's probably one area where where a seller cares how that gets allocated, because a covenant not to compete in an asset deal will typically end up being ordinary income to the seller, because of wages. But from a buyer's perspective, it's still a class 6 asset basically that gets 15-year amortization. So sometimes there's a little bit of negotiation in terms of how covenant not to compete gets allocated. So for the most part, I just think this is a waterfall. You kind of just fill up a bucket until you get to the next bucket, and then it gets full. When you look to the full fair market value, unless you're buying a business at a discount to the asset value, which you don't see that often, it does happen, you're going to end up getting the class 7 and allocating to your goodwill and total value. If, for example, you're buying for whatever reason a discount, you could be in a situation where you fill up classes 1 through 4, and class 5, the fair market value ends up being more than what you have left. Maybe you got a really good deal on your purchase, so in which case you're going to allocate based on the overall. Transaction costs, again, I don't want to get into too much detail on transaction costs, but basically, for the most part, what happens with transaction costs, there are some rules out there in terms of deductibility of transaction costs, which is a little bit better than capitalized treatment, but for the most part, you end up capitalizing transaction costs. Transaction cost is one area where when you look at how much the buyer sells their assets for and what a seller receives for the assets, it's going to be different. Buyer transaction costs increase the cost of the buyer. So if you're buying a business for $1 million and you have $100,000 of transaction costs, your basis, when we talk about that waterfall, how you're allocating purchase price, should be based on the 1.1 million, unless you have some opportunity to deduct some of your costs, which you may not do depending on the number of factors. But assuming that's not the case, you're going to allocate 1.1 million. Let's say now you're on the seller side. The seller got $1 million for their business, and let's say their transaction costs were $50,000. Their proceeds is going to be based on $950. So your delta there is actually going to be $150.
And on the buyer side, the transaction costs are going to be things about the tax. Like it's booked, it's not capitalized.
Yeah, transaction costs could definitely give rise to book tax differences. There's a few of the items that I'm talking about here give rise to book tax differences. I mean, you could also have, for example, for book and tax, depending on whether you're for tax, you're just allocating it to stock, whereas for book, you might have to allocate to you should have an investment account. I'm not a GAAP person, but I definitely it's a really good point, Robert, because you will see there's a variety of areas, and this is just one of them where you're going to have book tax differences. Everything I'm talking about is strictly from a tax perspective.
Avi, how do you calculate goodwill?
So if you think about it, from a tax perspective, it's a waterfall type calculation. So it's a residual amount. Think of it that way. So you start with your purchase price, increase, let's say, plus transaction costs, plus liabilities assumed, and that's your total purchase price you're going to allocate. You then sort of run through your waterfall and you say, okay, I'm going to allocate this amount to, let's say, cash or marketable securities. Most deals don't have that, but we get to accounts receivable, inventory, other assets, fixed assets, and the like that you sort of allocate down the line. Eventually, you're going to get to identifiable intangibles, and then whatever you're left with is your going concern, goodwill and going concern value.
So basically, it's just a made-up number based upon what you're paying for the company.
Absolutely.
And you deduct everything else, and then there's that spread, and that's the goodwill.
It's a made-up number that we, but really, it's. I mean, I think of it as a plug. I mean, it's basically it's the residual amount after you've done everything else, but I don't want to oversimplify the everything else part of that, because that's usually a negotiation. It's very common if you're doing an asset deal, buyer and seller are going to care how you're allocating to those other classes. So how do you determine how much you're allocating to fixed assets? That's one area that a buyer loves to allocate to, especially in a world of bonus depreciation if the assets qualify. And a seller, if let's say it's an S-corp transaction, a seller will end up having ordinary income because they've already previously benefited from the depreciation deductions. So once everyone agrees on all of this, it's a residual mathematical calculation.
Generally, you hire valuation experts to come in and value the categories of assets, including the intangibles, and then whatever's left is after you allocate the purchase price to all the things you value, what's left is goodwill.
Yeah, I think that's a good point. And the distinction that you're talking about becomes very important from a book perspective. How much you're putting to the various identifiable intangibles. There's different book treatment depending on what it is. For tax, you usually don't care as much because you're getting the same 15-year amortization. It used to not be the case. The rules changed, I believe it was in 1993 under Clinton. Before that, it was very messy in terms of how you allocated intangibles for tax purposes. There was a lot of cases and fighting and audits where people, this asset has a different life and they want to accelerate it. Some of them were, goodwill, I think, couldn't amortize at all. I think that because of all the litigation, everything that was going on, they just decided to simplify it and say, look, everything's going to be 15 years. Even if you can demonstrate the life of it is 3 years, it's going to be 15. And it kind of just have rules. And I think that was, in my opinion, just for ease of implementation because it was just becoming too difficult to implement another set of rules for tax.
And the book is trying to catch up with that, where now for private companies, as of maybe 4 years ago or so, where previously goodwill was not amortized, now as a private company, you can elect to amortize goodwill over a 10-year period, or shorter if you can support it. And then there's certain intangibles, customer-related intangibles, customer relationships, customer contracts, where that all gets lumped into goodwill. It can be, if you want, get lumped into goodwill and amortized over the 10 years. It's supposed to make it a little bit less burdensome on private companies from a valuation perspective, from costs and things like that, make it a little bit more easier and streamlined to be able to. So things like technology, tangible assets still get valued separately and amortized over 5 to 7 years or so. But there's a lot more, including the goodwill, that can be amortized now over 10 years. So similar to tax, where everything can be over 15 years, books started to make it for private companies at least a little easier.
And then you have, what is it, trademarks, covenants not to compete.
Yeah, the trademarks is still separately valued.
Right, see, for tax, those are all going to be 15-year. That would be what we call our class 6 asset acquisition.
But then you also don't have to test.
On an annual basis, you don't, it's only, it's just,
savings as well.
exactly. It's just like regular intangibles where you only have to test it if there's an indication of impairment. There's not an annual required impairment test that's performed platform. So we're typically do a step one test, and companies will go back to a valuation firm maybe on an annual basis and pay another 20-25K to have a valuation done now to support the goodwill. There's no impairment. Now that's not required anymore. So
It's not required for public companies, it's still
for
required.
public companies, yes.
Okay.
Yeah, one thing too also is even, so 1060 governs fair market value allocations, and that's how you go through the waterfall process. But you can also have agreed upon values too, based on buyer and seller, which may not necessarily equate to what's being done for GAAP purposes. So if you have buyer and seller have some sort of set terms as to which categories get what type of valuation based on some sort of mechanism, book value, tax basis, but as long as both buyer and seller agree to those positions, which I think Avi was alluding to, that the treatment has to have some sort of synergies, then that can also hold weight and be acceptable for tax purposes.
Absolutely. No, Peter, that's a great point. And so it's common in purchase agreements that you'll see, especially in an asset deal or a deemed asset type transaction, which we haven't really talked too much about, but where what would happen is buyer and seller will agree, and where I kind of laid out this class 1 through 7. I've actually seen a chart as an exhibit to a purchase agreement that has class 1 through 7 and saying, here's what we're going to do for tax. And they'll say, for example, accounts receivable, we're going to allocate book value. Inventory, we're going to allocate book value. Fixed assets, we're going to allocate book. Tax basis is ideal if you're a seller, but it may be a little bit less realistic. There's an argument to be made that book value might be a little bit more representative of fair market value. So because you don't have the seller for tax, they can literally bring off all their assets the year they bought them. So, and then, but once you come to that agreement, buyer and seller are bound by that. So if you agree in a purchase agreement to allocate for tax a certain way, buyer and seller are bound by it. What's interesting is the IRS is not bound by it. So buyer and seller will have to do that. The IRS can still come in and audit it, and if they disagree with the valuation, they can end up changing it for both buyer and seller. You very rarely, I'm not sure I've ever seen that, I just know that they could do it, and I'm sure it's happened. In most transactions, buyer and seller are going to be in adversarial positions where a seller wants to allocate as little as possible to these fixed assets, let's say, buyer wants to put as much to them. So the fair market value that they negotiate from there as part of the overall deal is generally something that's respected. Where I've seen pressure on this is I've seen, for example, an ESOP where an employee stock ownership plan where basically they don't pay taxes. So they said to the buyer, we don't care how we allocate it, they'll put like some crazy amount of fixed assets, and because they're not going to have it, but then the buyer gets to write it off for year one. Those are where we've kind of advised you may want to get a valuation. You want to not just agree because you're not really adversarial. There's a few examples like that. There's a lot of net operating losses and a buyer doesn't and a seller doesn't care. So you do see that sometimes, but I think but I think generally buyer and seller could agree, and from a tax perspective, there's no rule that says it has to equal what you're doing for book. It's common for book to do a evaluation. I've worked on deals with public companies where we tell them this and we'll go through it, and and the buyer says, look, we're a public company, we're not comfortable having an agreement out there that someone's going to find that says, well, because of a tax strategy, we allocate it differently. We want in the agreement that we're going to allocate based on whatever our valuation comes in at, because they just weren't, they didn't care about a few $100,000 of amortization deductions in terms of the optics of how the money works or so concerns there. As a tax person, I didn't see that issue, but it was their transaction. That was how they wanted to do it.
How often does the IRS want this? Is it all the time, or is it?
I mean, they would have to. The answer is, I don't know. I mean, I've never seen where you're truly in adversarial positions where it's coming up. I mean, I've worked on one transaction where there was a litigation matter, and I don't think it was an IRS, it was in bankruptcy, where basically someone I know basically had to go in as like an expert witness to talk about how this works from a transaction perspective, and how what you're agreeing to in your allocation may not truly, it's a negotiated amount as opposed to a truly fair market value, because it had to do within a bankruptcy context when someone was getting certain assets, so unrelated to really your question. But I've never seen it, but I don't know that I would unless, because I work on the transaction side, not necessarily the client side where returns get audited. If for that to happen, the return would have to get audited, the IRS would be successful. I'm sure it's happened. But it's usually, the IRS is not looking to kind of renegotiate the terms of the deal, especially if there's no agenda for them. Because what would end up happening is they would maybe get, a different value on one side, but then on the other side there could be, the other side, yeah, you know, it's not gonna be a perfect wash, but, you know, they've gotta look at, you know, the benefits of them, and nothing says that a buyer and seller can negotiate the price, nothing says that they can't, but the key is that if you're doing anything that's, like one of them is, I think a lot of people would be reluctant to just allocate this basis when you have fixed assets that you take bonus depreciation on, and allocate such a low amount, saying no one's gonna really believe that that's fair market value. So, things like that. We're gonna move on. I have some slides here that have pictures. These pictures are really just kind of depicting different things that we've spoken about. Stock stock acquisitions without a 338 election. Want to spend a few minutes, and we're already starting to run short on time, so I'm going to go through this very quickly. This just means a straight stock acquisition. I think we've talked about a lot of this already in kind of the general overview and some of the questions. Tax attributes are unaffected by the stock transfer, but there could be limitations on their use. Tax attributes are like net operating losses, the interest deductions that they couldn't take under tax reform, other things like that. Stock sale is exactly what it looks like here. It's the simplest transaction. An asset deal is much more complicated. A stock deal is literally two parties exchanging cash for shares of stock. It is very simple to implement. The attorneys like it a lot. And that's why we're going to get to some of the other strategies in terms of elections, where you can have the legal form of your transaction be as simple as this, and make an election that for tax purposes, where either buyer only or buyer and seller will have different treatment. This is other forms to do a stock deal. Sometimes it's not always practical to literally find all the stockholders and give them cash. If you have a closely held company, that's very easy. Imagine doing a deal of a widely held company or a public company where you have a bunch of small shareholders. It's more common for an acquirer to set up a merger sub and then through corporate law purposes merge the target into the merger sub with the target surviving, and all the shareholders get cash. You see, this is probably more common than really just paying cash for stock, unless you're dealing with closely held businesses.
How about if the shareholders get stock?
Well, if the shareholders get stock, depending on the overall transaction, well, in a stock deal, you mean, like if it's a stock for stock?
Well, it would be stock for assets.
I mean, typically, if they own
Buyer gives stock to the seller for the assets of the seller.
so I got it. So depending on a bunch of factors, that will either be taxable or tax-free. You could get to a tax-free transaction, essentially, if you meet the requirements, beyond what I want to get into again, but there are a series of strict requirements and analyses that need to be done. But there are transactions, and it has to do with how much cash is involved. If it's a combination of stock and cash, it's sometimes a little bit harder, but there is capacity to do some small amount of cash, and there's a bunch of rules on that. But essentially what would end up happening is, if it doesn't qualify as a tax-free transaction, so if it's a taxable transaction, then the fair market value of the stock would be considered fair proceeds. That's a fully taxable transaction. You could have another type of transaction where it qualifies for tax-free, then the only thing that would be taxable would be the extent of what we call the boot, which is essentially the cash that they get. And if all they get is stock and it's a tax-free transaction, there would be no immediate tax impact. What would mean is whatever their basis on what was transferred would move over to the stock. So the fair market value of the stock would essentially have that built in. So if they sold the stock the next day, they would recognize the gain. That's if it fully qualifies as tax-free. And there's a bunch of, you could do a stock for stock, asset for stock, some hybrids, set up mergers. I mean, there's a lot of different ways to do these types of deals, and you can get to a tax-free answer. If there's a tax-free deal, you're not going to get a step up in the assets either. You're going to get a carryover basis. You won't get a book basis. I'm not going to get into the attributes. I want to spend a minute on this slide actually, just before I get into it. This is really just depicting. I just want to make sure everyone really understands the points we're making here. Let's say we have this situation where we have a seller has a $20 basis in T and target, and the target has a $20 basis in the assets, AB's adjusted basis, and the fair market value of the stock or the fair market value of the assets is 100. So they can sell either the stock or the assets for 100. What are the implications? P pays $100 for the stock. They would get a $100 basis in the stock, and S would have a capital gain. They get 100. They had a basis of 20. Their capital gain is 80. There's no depreciation of the stock. There's no amortization. There's no step up. It's all sitting in stock basis. Same deal in an asset transaction. he pays $100 for the assets. The target, T, has an $80 gain. Some of it is ordinary, some can be capital. For corporations, there's no difference in rate between capital and ordinary. If there's a flow through, it flows up to the shareholder differently if it's an S corp. But corporation still prefers capital gain to ordinary income, because if a corporation has outside of the transaction capital losses, they cannot offset ordinary income to capital losses, but they could offset capital gains. So capital gains are still better for a corporation if they have capital losses that they otherwise would not be able to use. And they can't carry those forward indefinitely. It's like 5 years for capital losses.
5 years, yep.
So corporation capital gain is definitely better if they have capital losses. He would get the depreciation and amortization deduction because they bought the assets. There's a second layer of tax though. So what happened is he would have a gain of 80, and then so there would be they pay tax on the $80 gain. So let's say they pay tax on the $80 gain. Let's say the tax bill is $25, for example. So they got $100, they paid tax of $25, they have $75 left. They now distribute that $75 up to the seller. Seller has a $20 basis. Let's say it's a full liquidation. There's nothing left in this business. Seller now gets $75 for their stock. They have a $20 basis. They pay tax now on another $55 gain. So that's your second layer of tax.
Just go back to that 1 second. So also, if you're working with your JT and issuing financial statements, whether you're public or private, there's a section of the codification rule in 805 that under this scenario of an asset purchase, you may not have to do certain type of journal entries for purchase accounting, but if you're doing stock purchase, there's separate rules that you'll have to calculate deferred tax liabilities or assets depending on what type of assets you're inheriting based on the transaction itself. So an additional layer of accounting that you'll have to do on day one with the stock acquisition, whereas on an asset acquisition you may not have to do it because if all your assets are aligned on day one, you can avoid calculating those DTLs or DTAs if you have applicable financial statements.
I'm going to spend a few minutes on 338 elections. And 338 election is a very powerful tool from an M&A perspective. We see it a lot. There's two different kinds. I don't want to get too caught up in the mechanics. We have 338H10 and 338G. 338G, you almost never see. That was where I was talking to you about in the NOL context, where you can basically buy the company and say, buyer only will make an election. We're going to pretend that the company sold the assets, trigger the tax, and use the NOL. You would only see that from a practical perspective because you're triggering all the gain. If the company has a lot of losses, you also see it with foreign companies as well, where they wouldn't be subject to U.S. tax, so they don't mind triggering the gain. And there could be other benefits to doing it. So I'm not going to really focus on 338G. There are some slides in the materials as reference if it's relevant to you, and you can always reach out with questions. 338H10 is much more common. A lot of S-corp transactions. It comes up probably on every transaction, and it's talked about whether or not you're going to want to do that. It's also used if you're buying a subsidiary of a consolidated group. So if a corporation is selling another corporation, you could also use a 338H10 in that context. I generally see it more on the S-corp side, but it could come up in other contexts. Essentially, to make a 338 election, what ends up happening is, notwithstanding that the legal form of your transaction is a stock deal, and nothing changes from a stock purchase agreement perspective, it is a true stock deal, buyer and seller will agree. It is a joint election. They both have to agree to it, and if it's an S-corp, all shareholders have to agree to it because they're all impacted. To pretend for tax purposes that we did an asset deal. So the tax fiction is, even though your legal form is a stock deal, buyer and seller agree that they're going to take the tax treatment and have it as though the S-corp, in the case of an S-corp, where the target company sold its assets and then liquidated. So the shareholders end up getting the cash through the liquidation, and the buyer ended up effectively, it's like a new target company, and it's a new target company bought the assets. So I think the EIN would still carry over, but for all tax purposes, it's basically considered a new tax-paying entity, has a stepped-up basis in all the assets. Any attributes or tax elections, anything like that, you can generally start over. So it's a very powerful tool because it kind of gets you this asset deal treatment without the legal and other business issues of having done an asset deal. So you need a qualified stock purchase, and you need to make an election on a form. The form is due an 8.5 months after approximately after the deal closes, not necessarily the tax return due date, so that's an important point too.
So, but just to be clear, on the extent election, does it trigger double tax, or it only changes the nature of the tax in the hands of the seller?
So that's a good question. So we talk about it in the S corp context. In an S corp, it's a single layer of tax anyway. But what it does is it will create a higher tax cost to the seller because you now will end up allocating costs to ordinary income items, and also there's the state and local, which some deals it's a huge issue. So I've worked on deals where there's very little ordinary income, but if you have a shareholder in Florida and a business that operates in New York and California, it'll be too cost prohibitive to even consider that. So those are reasons. In a corporate context, you wouldn't really have the double tax issue because remember, it only works if it's a subsidiary. So if it's an individual who owns a corp and you're selling the stock as an individual, the 338H10 is not available to you. It would only be available to a corporation selling the stock of a subsidiary, and you don't really trigger the double tax until the money leaves the upper tier parent.
Yeah, but if the money does come out, then you would trigger double tax.
Absolutely.
Because that gain is going to increase your earnings and profits inside the company, subjecting you to that double tax.
So
When you
it's
pull the
not
money out.
applicable for an individual selling shares of a corporation?
If for an individual, it would have to be an S corp.
Okay, but if it's a C corp, it's only if the C corp sells a subsidiary to somebody else?
Yes. And to Peter's point, also, we talk about when the money comes out of that upper tier corporation, it absolutely triggers that second layer of tax. But that would be the same in a stock deal or an asset deal or a named asset deal, because it would be the corporate seller selling the assets or the stock. Once the money leaves that upper tier corp, you can have that second layer of tax come into play.
Yes, so Robert, if you had that sale triggered in a consolidated return context, and parent wanted to, use those funds to expand operations in a separate division of their business line, maybe they had multiple business lines, and that sub that they just wanted to unload, they didn't want it anymore, they wanted to get out of that business. They sell, there's a gain, they pay tax on it, and they use those proceeds rather than distributing to the shareholders, they reinvest it to another company, another trade or business within their consolidated return group. You've avoided or deferred that double tax that could be troublesome to the corporation and to the shareholders.
I don't want to spend too much time on the requirements, but I mean, the 338H10 is available to you. You essentially have to be buying 80% of the company. Over a 12-month period is usually irrelevant. Usually the closing takes place at a table on one day. But if you did some sort of a slow acquisition of the business over a 12-month period and you get over 80%, this election could be eligible to you. And it must be a corporate purchaser. That's one of the critical requirements of the 338H10. There were other elections that we'll talk about that don't require that were not available until about 5 years ago. Benefits of the 338H10, I think we talked about this already. It's basically, think of all the benefits of an asset deal, but the key is you're not reliant on the form of the transaction. But this is a very important point. Due diligence is still required. The tax consequences are not dependent on the form of the transaction, but just remember, you legally did not do an asset deal. Legally, you still bought the stock. Whatever diligence you would do on a stock deal for contingent liabilities, for tax matters, whatever, that all still has to be done. Don't look at this as any different from a due diligence perspective. Just realize you're getting a tax benefit as a buyer of this type of a transaction. One of the things too that's most critical specifically from a tax due diligence perspective, this puts a lot of pressure on the validity of it being a good historic S corporation, even if this is an S corporation target. Because if it turns out that the IRS comes in and audits down the road, we talked about the historical liability earlier, the IRS comes in and audits you and says, you have an issue with an S corp status, so you owe 21% of your income for the last 3 years. That's bad. Usually you would have an indemnity to protect you, but it also means that your election was invalid because you can only make this election. Remember, if you have an individual that owns an S corp and that S corp is not a good S corp, so it turns out to be a C corp, you have an individual in the C corp, the 338H10 would not have been available. Your whole step-up's gone. So it puts a lot of pressure from a due diligence perspective on making sure you have a valid S corporation. Just skip over some of these other this 338G, this is more what we talked about with NOLs and foreign companies. You see it. I'm skipping over a lot of that. 338H10 also is, we talked about. I see it much more in the S corp context. You could also see it in a parent-sub relationship. Similar types of treatment. This slide kind of gets into some of the technical issues you deal with the deed sale and multiplication. I would have talked to a few other things on. This is again, I focusing more on the S corp side because that's where I think you see this election more. Is you have a deed sale of assets by the old corporation and deed purchase by a new corporation. There is no new and old corporation. Legally, you sold the stock. This is all a tax fiction. That's an important point. But subject to built-in gains tax, which is basically you only have in an S corp context. If you've been an S corp for less than 5 years, you can end up with what's called a built-in gains tax. It's almost an anti-abuse mechanism where it would be really good if you're a C corp and you say, hey, I know I want to do an asset deal. Let me and let's say you're an individual who owns a C corp. You're going to say, well, let me make an S election and I'll do my asset deal next time. And then I've eliminated a second layer of tax. What these built-in gains tax rules basically do is, from the time you make an S election of a C corp, there's a 5-year period that if you do any sort of an asset or a deed asset deal, you're going to basically trigger the second layer of tax. It's a little more complicated, but that's basically what it is. The deed sale of the gain is allocated to the shareholders. For tax purposes, income tax purposes, this follows all the way through. So you basically have an S corporation sells its assets, that gain goes up to the shareholders on its K1. Character remains, so it could be ordinary, it could be capital gain, that all remains. Just remember, when a shareholder in an S corp picks up gain, their basis goes up. That's how you eliminate that second layer of tax, because they get an increase in basis. Whereas when a C corp gives you money, when a C corp has earnings, you don't get basis for it. That's why there's a second layer of tax. This last bullet is I think really important though. This goes to from a seller's perspective, there is that incremental tax to doing a 338H10 election. So it could be in the form of ordinary versus capital, marginal state and local taxes is a big one. That's where we talked about if you have a Florida shareholder, or it doesn't even have to be Florida, it could be a state that has a 3 or 4% rate, but if the businesses operates in New York, New Jersey, California, picture your high tax states, there's going to be a marginal state tax cost as well, and that's a permanent difference. So 1374 is the equivalent gains tax of these code sections. This is a key thing. The 338H10 is a joint election. The buyer and seller have to agree to it. As an S corp, every S corp shareholder has to agree to it, even those that do not sell. Remember, you don't have to do. You could do an 80% deal. So if you have a 10% S corp shareholder and who's not selling, and you're buying 90% from everyone else, that S corp shareholder is going to be impacted by this. That S corp shareholder has to agree to this, and it's going to trigger tax to them because they're going to lose any. But they're going to almost be treated as though they sold their 10%, paid all the tax, and then they rolled over after tax dollars. So it does impact even those that don't sell. So you always want to be aware of it if there's going to be rollover. Rollover is a big issue actually in transactions because rollover is the sellers always want to be able to roll over on a on a tax deferred basis. Most people can say it doesn't make sense. I'm not selling this. Why would I pay tax on it? Some transaction structures will trigger the tax on those, and technically what would happen is the